Hey guys, my name's Ryan Perry. I work on the acquisitions team here at RREAF. And today I'm going to take you through what I like to call the A to Z of multifamily acquisitions. So just a short agenda of what we're going to go through today. Basically, we're going to go all the way from sourcing a deal to closing a deal, which involves processes like looking at financials and really digging in and showing what they tell you. Then we're going to move on to underwriting, which is the modeling of how you think the deal is going to perform over the next 5 years. Market research and trends, really buttoning down on what's happening in the market, what kind of economic drivers there are, what kind of rent growth you can expect. And then we move on to presenting the deal to IC, making sure that everybody in the company is on board and supports us in that deal. Then the bidding process, followed by LOI and PSA negotiations, due diligence, getting into the asset and making sure we know everything about it. And then finally finishing up with securing financing, raising equity, and closing the deal. Just as a little aside, each one of these topics I could probably go on for an hour about, so we're going to stay at like a 10,000-foot view just in the interest of time. So first, we're going to talk about sourcing a deal. There are really three main ways that we source a deal here at RREAF. The first is fully marketed deals. So these are deals that sellers go to brokers and they'll market the deal to anywhere from 250 to 500 groups just like us across the nation. We typically don't transact as much on fully marketed deals just because they're highly competitive, and a lot of the times the price gets inflated over where we think there's the true value is at. So I'd say less of our deals here at RREAF are fully marketed deals. Really, most of our transactions fall into the off-market deals category. And this is when a seller will engage a broker, and the broker will then contact a list of 5 to 10 groups that they know and have transacted with and trust, and give them the exclusive opportunity to look at this deal. And this is where you kind of get a lot of great value, just because there aren't so many groups that are pushing up the price, and we find a lot of value in off-market deals. The third is direct from seller deals. This is definitely the least common, but we do have probably 3 to 5 assets that we've acquired this way. This is just from knowing people in the industry, knowing other owners, and maybe if they don't want to go through the whole process of marketing a deal, they'll just come to us and say, hey, we're done with our business plan on this deal, and we're looking to dispose of it. Would you like to take a look? Down here, I kind of have 5 of the main national brokerages that we've worked with. Cushman has a great team in Atlanta and Augusta that we work with. CBRE, we've done a big deal with them out of their Atlanta office. Colliers, we've done a lot with them in the Houston and greater Houston area. Newmark, traded a lot of deals with them in Little Rock, and finally Marcus and Millichap. We bought a few deals in Texas from them. So now financials and what they tell you. Financials are basically detailed summaries or detailed financials of what's happening at the property. How do we track how much money we're making and how the performance is trending. So the first is rent rolls. What this tells you is who lives there, how long are they going to be there? That's their lease start date and their lease end date. And how much are they paying? Next is T12s, sometimes referred to as operating statements or profit and loss statements. This tells us how much income is being produced, what are the expenses to keep up with the property, and most importantly, what's left over? What is our profit? Next is tax bills. Much like residential real estate, on these commercial properties, we have to pay taxes to the government. So we'll look at how much are owed in taxes, not only this year, but 5 years in the past, and kind of looking at how the deal how taxes have evolved over the past 5 years shows us how they're going to continue to evolve while we potentially own the deal. Next is lease trade-out reports. This is detailing, are we getting new residents? Are we getting people who already lived here renewing leases? And whether or not their rents are increasing or decreasing compared to their old leases. Age receivables report. This basically details, are people paying their rent? We don't live in a perfect world. Sometimes people are late on their rent. So we want to track, is this person just a couple days late on their rent and we don't really need to worry about it, or has this evolved to this person is 30 days, 60 days, 90 days delinquent on their rent, and are we going to have to look at maybe evicting them? And then rentable items directory, this doesn't apply to every deal, but certain apartment buildings have rentable items like storage units or garages. Sometimes carports or reserved parking fall under this category. Just because these aren't included in the rent roll, we have a separate tracker for that, just to make sure that we that's considered in our income calculation. So here we have a rent roll. I've blacked out the names just for privacy's sake, but you can see we have our unit numbers, our unit type, which is our floor plans, all of our square footages. You can see that some of these units are vacant. And then we have our market rent. The market rent is the rent that we are trying to charge for the unit at that time. Then next to it, we have our actual rent. So you can tell that sometimes, in some cases, the actual rent is lower, in some cases it's higher. And that just happens because there are ebbs and flows of the leasing cycle. And sometimes to manage occupancy, we have to drop the rents a little bit. But then sometimes there's high demand months like the summer where we can actually charge more than market. And then you have our move-in dates, our lease expiration dates, and towards the bottom you can actually see we have 2 people moving out in August. So these are all important things to look at and make sure that we comprehend what's happening at the property. One thing, for example, is you want to look at all your lease expirations and make sure that we don't have 30% of the property that is expected to move out in August. If they're all going to move out in August, we might have an occupancy issue coming up. So these are all things that we need to dig in and make sure we fully understand. This is our T12 or operating statement. This is just a portion of it. These often stretch, 200 to 400 line items. So this is just the income section, but you can see that month by month it details how much rent are we collecting, how much of that are we losing to vacancy, things like that. So this is another thing that we'll dig into really deeply and make sure we understand the income and expenses that are happening at the property. This is a property tax statement. This particular one is from an asset that we have in Georgia. There are 3 things that play into a tax assessment, and the first is the fair market value. Sometimes it's called the fair market value, sometimes it's called the appraised value. So basically what that is somebody who works for the county will come out and they will appraise your asset and assign a value to it. And then what's called an assessment ratio will be applied to it. So in this case, you can see that the fair market value is 12 million-ish, and then the net assessment is 4 million-ish. So they have around a 40% assessment ratio in this county, and that changes from every county. So you just have to make sure that you dig in and get this right. So what we're actually taxed on is our assessed value, which is our appraised value times our assessment ratio. And you take your assessed value and you multiply it by the millage rate, which is effectively your tax rate, and that gives you your gross taxes. So like I said earlier, this is the 2024 statement. If we were going to look at buying this deal, we'd go all the way back to 2020. We like to look at, when did the last owner buy the deal, and where relative to their purchase price was the property appraised when they first bought it. And that'll help us back into where we think taxes will be on a reassessment when we buy it. Here we have a lease trade out report. You can see that we detail new leases as well as renewed leases. This is kind of something where you always want to balance how many leases are we getting new leases and how many leases are we getting renewals, because in most cases, your new leases, you're going to get a higher amount of rent growth, but you also incur an added expense because you have a turnover expense where you have to touch up paint, touch up cabinets, make sure that it's ready for the next renter. So it's kind of important to weigh the cost-benefit analysis on whether or not we want to renew our tenants or we want to move on to a new tenant and be able to charge a higher rent. Here we have our age receivables report. You can see for each unit if they have any delinquent payments. You can see that all of the positive numbers are people who actively owe money to the property management company. And you can see that this person owes $42.97, but they've only owed it for 0 to 30 days. So that could have been, I missed rent by 3 days. So we really don't start to worry about that until we see it move over into the 30 to 60 days, 60 to 90 days, and over 90 days. That's when we start to consider taking action against the tenant and possibly have to move to evict them.
And then there are the negative ones of it.
Those are prepayments. So some people will prepay rent as a way to get a lesser rate. They'll offer, hey, I'm going to pay 6 months in advance. Here we have our rentable items directory. This is an important thing to dig into just to make sure that we have this contemplated in our income. So at this property, you can see that we have 5 garages, and this property actually has 192 units. So there are 192 people that are only available, and there's only 5 available garages. So this is going to be something that you can see they're 100% occupied, and that kind of tells me that there might be a good opportunity to raise the rents on the garages because we have so few of them and they're in such high demand. So you can see that on our older leases, we were getting $350 per month for the garage, and on this newest lease that was signed in June, they're getting $450. So little things like that, you need to take into account that, hey, how are we going to improve current operations at the property? Next is underwriting. So underwriting is when you take all the financials that we just discussed, you import them into a model to make sure that you know how is the asset performing today. From there, you build out a business plan, which includes renovations, if applicable, adjusted expenses based on how we think we'll be able to run the asset, and then finally, modeling the sale of the asset. The other thing you have to consider is financing the asset based on current cash flows. How much debt can we put on this asset and how much can it handle? In turn, how much equity are we going to have to raise to do this deal? So all those things factor together to build out a cash flow and ultimately give our investors their returns. And based on all of that information, we're then able to evaluate the property and say, hey, where do we see value and where do we think we can offer on this? This is a couple screenshots from our underwriting model. This is the dashboard, and it's really nice because you can see all of our rent growth assumptions, debt yield, return on cost, financing assumptions. So really just in one screen, you can see almost everything that you need to know about the deal, including the returns, purchase price, soft costs, renovation cost, everything. So that's something we really like about this model. Here's the 5-year pro forma. You can see on the right years 1 through 5, and then here on the left you can see the trailing numbers, how it's operating now, and how we expect it to operate. And this is how we build our cash flow. So next is market research and trends. So a lot of times when you're like in the bubble of just working in an Excel document, it's easy to say, hey, I think this will be the rent growth. Hey, I'm looking at this. I think there will be this amount of rent growth or this amount of expenses. We really need to dig into the market to make sure that the assumptions we are making are viable for that market. So the first thing we'll look at is rent comps within the surrounding area. We always want to make sure that we aren't charging too little or too much for rent. We need to be comparable to the other competitors. Next is the sales comps within the surrounding area. So if we're looking at buying this deal for $100,000 a unit, but then we saw that 3 months ago, a deal across the street that's very similar only sold for $75,000 a unit, we may need to look back and say, hey, maybe we are overpaying for this, or maybe we need to go back and look. Same for the exit price. If we're modeling an exit price at $200,000 a door, but nothing is ever sold above $100,000 a door, we need to go back and look and make sure that that's a reasonable assumption that we're going to be able to exit at that value, given the historical trades. Next is a neighborhood scout report. This kind of tells you things like how is crime in the area, how are the school districts, and general things like that. And then arguably some of the most important stuff that we're seeing recently is the supply and absorption in the market. So the supply is all the newly constructed units that hit the market every year. So we need to look at over the next 3 to 5 years, how many units are going to come into the market, and then on the other side, how many are going to be absorbed. So you want to look at how many units are being built, and also how is population migration in the market forecasted. Some other things like in the absorption area are the economic drivers. We need to look at what new jobs are being built or being added to the area, and do those apply to the product that we're renting. So let's just say, for instance, we're looking at buying a very, very nice apartment that charges super high rents, and there's an Amazon distribution warehouse that's being opened and they're adding 400 jobs. Well, we're charging these high rents and these are relatively low paying jobs. That's probably not going to be relevant to us. That would be more relevant if we were buying workforce housing. So you need to make sure that the jobs that are being added to the area are relevant to the property that you are looking at buying. Here you can see a chart and graphic that details the rent comps in the area. I really like this graphic because it gives you a good visualization of where rents are in the market. And you always want to stay like kind of in this general trend line. So you can see red is where our rents start, and green is where we figure they'll be in 36 months. So if we were coming into this and we saw a red dot all the way down here, we'd say, hey, we really have a lot of room to move up the rents because all this stuff is up here and we're way down here. On the contrary, if our green dot is way up here, we know that we've increased rents too much compared to the market and people are going to go to other places. So things like this we use to just make sure we're making the correct rent growth assumptions. Here you can see the submarket absorption and net deliveries. This is what we were talking about earlier with the construction of new units and the absorption through population migration. So here we can see that in 2022, we had more net deliveries than we had absorption. So that results in vacancy in that market rising that year. But then you can see over the next 4 to 5 years, we have absorption outweighing net deliveries each year. So vacancy is going to go down, and as vacancy goes down and the supply-demand kind of tips back in our favor, rents are going to naturally go up as there's more competition in the market to get an apartment unit. Once we've made all of our assumptions, researched the market, and built out a pitch deck based on our model, we'll present the deal in IC. So here at RREAF, we like to involve everybody in our acquisition process because, when Jack or I or Charlotte are underwriting a deal, it's very easy to get tunnel vision and like whatever assumption I made is right. So we like to bring in everybody who is getting fresh eyes on the deal and may have a more unbiased view on like, hey, have you considered this? So we'll field questions and comments after we make our presentation. And based on that, we'll make changes to our model and make sure that we're actually underwriting this thing as close to possible or as close to actual performance is going to be. And based on that, we're going to decide whether or not we're going to proceed to the bidding process. So the bidding process really kind of varies between the fully marketed deals, the off-market deals, and the seller direct deals. This mostly applies to the fully marketed deals and kind of the off-market deals as well. The first thing you'll do is they'll have a call for offers date. They'll say that on August 30th, we want you to submit your offers on this asset. So most deals will end up getting 10 to 30 offers, and that kind of just depends on the ebbs and flows of the market. But of those 10 to 30 offers, the next round of bidding is called best and final offers. If you're in the top 3 to 8 groups, you usually get invited to best and final. So this is an opportunity to really sharpen up your numbers and decide, hey, do I want to push up on pricing a little more because I really want this deal? As you're doing that, you're also conducting buyer interviews. So the seller, you'll set up a call with the seller and they'll ask you questions about your financing assumptions, your rent growth assumptions, your ability to raise equity, how many deals have you closed in the past? And generally this is just so they can kind of get to know you a little better and make sure that if they award you this deal, you're going to be honorable and you're going to close the deal. And then based on the best and final offers and the buyer interviews, the deal is finally awarded. So the seller will select a group to award the deal to. And it's important to note, this isn't always the highest offer. There have been deals in the past that we won and we weren't the highest offer, but just because of the reputation that we've built in the industry, the selling group was more comfortable proceeding with us at a lower price than a group that didn't have as good of a reputation with a higher price. So another reason that you always need to make sure that your reputation is upheld well. Then once the deal has been awarded, you move into LOI and PSA negotiations. So LOI, letter of intent, that's what you send the brokers to give them your offers. So really you've been sending those in your bidding process. They're legally non-binding. Again, we like to uphold our reputation, so we don't like to just throw around LOIs. When you write an LOI, you need to mean it and be able to, or be ready to stand behind it. It's used as the framework for the PSA, which is the purchase and sale agreement, which is a legally binding document that will detail every step and every procedure throughout the sale process. Just as a frame of reference, the LOI is usually about 4 pages. The PSA can be anywhere from 40 to 60 pages. So it really, really gets down into the details. Some of the items of interest that are outlined in the LOI and PSA, this, of course, this is a 40 to 60 page document, so this is just the beginning of it, but some items are timing. How long are you going to need to do due diligence on the property? How long are you going to need to close? Do you want to build in any stipulations for extensions? How much earnest money are you willing to put down? Which means how much money are you willing to put in an escrow account that says, if I back away from this deal, I'm going to give this earnest money to the seller. It's like an act of good faith. Like, I'm presenting this money to say that I'm going to close this deal. And then seller deliverables and timing. So due diligence. This is arguably the most important part of the entire process. Usually, by the time we submit an LOI, we've gone out and visited the property, but a lot of the times the brokers are keeping you away from the things you don't want to see and showing you the things that show really nice. So once you get in the due diligence phase, that's when you get access to the full property. So we'll bring some of our RR Living team to help us with the property management assessment, and then also RCS, RREAF Construction Services, will come along with us. During this time, we'll walk 100% of the units, the common areas, look at all the amenities, and we'll make sure that we have all the right assumptions. So like maybe we get out there and we realize that their HVAC systems all need to be replaced, and we need to build in the cost that it's going to take to do that. So these are all things that we're going through the property, and we're constantly evaluating our underwriting and changing our underwriting to make sure that we have the most accurate representation of what the true business plan is going to be. Ordering third-party reports. This is like a appraisal, property condition report, which details the condition of the entire property. Environmental site assessment, make sure there's, no endangered species on the property or things like toxic runoff or things like that. And there's more like zoning stuff and termite inspect, like things like that are third-party reports. And then, like I said, we're always modifying our underwriting to make sure that our business plan aligns with what we know about the property. This is from a initial DD walk that we did a couple months ago at an asset in Fort Worth. We kind of were inspecting the amenities, the pool, the outdoor gathering area, the gym, more common areas, a sitting area and a game area, as well as this is just in the model because it was the first visit we did. We didn't actually get access to 100% of the units and see how the tenants are actually living in them. This is important. The reason we walk 100% of the units is you have to get a feel for how are your tenants like living in this space. Do I have tenants that are very disrespectful to the property, and in turn I'm going to have heavy turnover cost when they move out? Instead of just touching up paint, am I going to have to replace drywall and replace cabinets? So we're constantly trying to figure out what expenses are we going to have to spend to keep the property running. Next is securing financing. So mostly there are 4 types of financing that's typically used on multifamily assets. We mostly just go with agency loans and banker bridge loans. Agency loans are typically 5 to 10 years. They're available in fixed or floating rate. Fixed rate meaning that your interest rate stays the same throughout the entire length of the loan, and floating rate meaning that at the beginning of every month, depending on economic factors, your interest rate can go up or down. So in the past 2 or 3 years, we've been in a historically low interest rate environment. So all the deals that we bought, we put long-term fixed rate debt, and we're able to lock in really attractive financing for the next 10 years. Now that we're getting into higher interest rate markets, we may look at going floating rate, because if we think rates are higher now than they are going to be in 10 months, it's more attractive to go with floating rate financing so we can take advantage of those rate cuts. And with floating rate debt, you can also buy interest rate caps, which means basically you're buying a cap on what your interest rate can be. So if inflation is through the roof and they're raising rates, we actually are protected from that past a certain point with our interest rate cap. So it's a way to artificially fix a floating rate deal. That's the SOFR curve. That's what forecasts what rates are going to be over the next couple of years. And this is the 10-year Treasury and how it's performed in the past. You can see that we're coming from lower rates and going to higher rates in the recent months. The next step is raising equity. So once we've completed our underwriting model, we'll get with the marketing team and we'll work on building out a package. This is from our last equity raise, the SE3 portfolio. So once we start putting together this package that details our financing that we're putting on the property, our business plan, all of our assumptions, market information, it's a holistic way to show investors what this deal is going to be like. Our IR team will work to field questions on the package and help the investors ultimately decide whether or not they want to invest with us. Okay, now that we have both the debt and the equity, it's time to close the deal. So this is arguably like the most complex part of the deal, but I'm going to grossly simplify it just in the interest of time. So the first thing that we're going to look at is prorations. What this means is I don't know if y'all know this, but rents are collected on the 1st of the month. So if we buy the deal on the 15th of the month, we need to make sure that we're getting prorated rents from the seller, which means if we're buying it on the 15th, we're going to need half of the rent that they collected on the 1st to go to us. Same with taxes for the year. Then we're going to move on to the transfer of management. We get a lot of help from RR Living on taking over the website, the leasing software, and the social media pages. Finally, we move on to the wiring of funds, the transfer of ownership, and then you've closed the deal.